Our final type of adjusting entry is going to be an accrued revenue type entry. And so again, when we think of the word accrued, we think of something that hasn't been recorded in the books at all as yet. And now we need to record it to make sure the revenue is posted in the right period. Okay. And so with accrued revenue transaction, it always involves some type of asset account and a revenue account. The asset account we refer to in most cases for this is going to be some type of a receivable account. So with accrued expenses, we saw where we use a lot of accounts payable or payable accounts. With accrued revenues, we are accruing to receivable accounts. Revenues and receivables go together. Payables and expenses go together. And so in this case, we are recording accrued revenue, meaning that we're creating a receivable for something. Okay. And so asset account most times is going to be accounts receivable as long as it's related to selling goods or providing services, what the company normally does. Sometimes it could be slightly different with a different type of a receivable, but we'll see that example shortly. And then, like I said, the other side being revenue. So in the first one, it says as of June 30th, invoices totaling $2,500 for services rendered during the month remain unrecorded. And so that just means that services rendered is telling me that I did the work. And so therefore, I have earned revenue. When I earn revenue, I'm to increase my revenue account by the value of the services that were performed. And so therefore, they're telling me that in June, I had $2,500 worth of revenue that's not recorded yet. It's unrecorded. So that means as an adjusting entry, I now have to record it. And so on June 30th, because I'm making sure my revenue is in the right month, June 30th, I'm going to debit my asset account and credit my revenue account to now record this revenue that has been earned, but it just hasn't been paid to us yet. And so that means that it's a receivable to the company. And so accounts receivable is what I would use. And I would record two accounts receivable for $2,500. Services revenue, in this case, is what I would call the account, is where I would record the revenue aspect. Okay. And so this one is straightforward. We've done this before in basic entries. Whenever you have performed services, you should record the revenue, whether you receive the cash for it or not. The second one says, a services contract of $3,000 completed by the end of the month has not been invoiced or recorded by July 31st. So if something has not been invoiced, has not been recorded, that just means that it's supposed to be revenue, but it's not revenue yet. It's never been posted to the revenue account. So as an adjustment, we now have to make that post to the revenue account. And so they said it hasn't been invoiced or ordered or recorded by July 31st. So in this case, July 31st is my entry. And I'm going to now record it again to accounts receivable for $3,000. And then my revenue, I'm going to keep it at services revenue for $3,000. Now, it has been, once I post this entry, I would see that my services revenue account would have increased by $3,000, saying that it's now been recorded. Okay. The third one says interest on a $20,000 note receivable is due monthly at 12% per annum. So just like how a company can pay interest out for something that they borrowed, companies can also lend money out and they are then paid interest for the amount. And so what happens is we now have to record an interest receivable and interest revenue. And so let's just say this December 31st, what we're going to do, interest receivable, and then credit to interest revenue. Now, the only thing left is to determine how much. They didn't tell us how much. It's not going to be $20,000 because $20,000 isn't the interest, but it's the amount that I borrowed. When I borrow funds, my interest is going to be principal times rate times time. And so what I tend to do first is I say, okay, this is the principal, the amount that I borrowed, and I have to pay the interest on. So $20,000 times the rate, 12%. So 0.12. This is going to be how much interest they're going to pay for the entire year. Because I'm recording only for the month of December, or if I was recording it just for the entire year, I would put the 2,400 here. But I'm going to assume that for the month of December, that's the only month that I haven't received the interest for. And so therefore, I need to calculate the monthly amount of interest. 2,400 divided by 12, 12 months in a year, that's the time. So per annum, a year, 12 months, and I'm recording an entry for 1 month. I'm going to divide that annual amount by 12, and it gives me $200. And so that means $200 is recorded as an interest receivable. $200 should be recorded as interest revenue. Okay? And so these are pretty straightforward. Accrued revenue transactions adjustments are straightforward because it's either going to go to your regular accounts receivable, or if it's something special, it will go to its own receivable account. But again, no matter what happens, it's going to be a receivable account or an asset account that is debited, and then it's going to be a revenue account that's credited. It's just going to be sometimes determining the amount. And so in this case, they gave us these two amounts. Here, they didn't give us the amount. We had to calculate how much interest would have or should be receivable, because we're assuming that we did not get paid the interest as yet. But for December, there's only $200 worth of interest that needs to be received on this note. And so therefore, we have to record the revenue in December, because as long as the funds are outstanding in December, I'm owed interest for the month of December. And so I'm recording that revenue, and I'm recording that receivable as well. And so you'll find that things like interest have its own revenue and receivable account. And so they go together. An accounts receivable goes with whatever revenue account the company has. So if that revenue account is service revenue, landscaping revenue, babysitting revenue, they go together with a receivable. And so receivable in this case would always be debited, and revenue would always be credited to record revenue that has never been recorded in the books, but the work has been done or the service has been performed, and therefore it's earned.